On May 27, 2026, Canada's Prime Minister bypassed Washington entirely, landing instead in New York City to initiate a structured economic offensive. Within 48 hours, America's most powerful chief executive officers were actively lining up to meet him in corporate boardrooms rather than government offices. That highly compressed sequence of events reveals a calculated strategic shift in how America's largest trading partner intends to manage its relationship with Washington. This sudden arrival in Manhattan occurs at a critical moment in Continental trade diplomacy. Just days prior to this trip, United States and Mexican trade officials formally initiated bilateral talks regarding the upcoming review of the Canada-United States-Mexico Agreement, known as CUSME. Because Washington had not yet scheduled equivalent formal negotiating dates with Ottawa ahead of the mandatory July 2026 review trigger, Canada chose not to wait for a diplomatic invitation. Instead, the administration deployed its economic blueprint directly to the institutional capital managers who fund the American economy. That choice of destination is a direct policy statement. By targeting Wall Street before negotiating with Washington, Canada is deliberately leveraging its status as a vital component of the United States economy. In 2025, total trade in goods and services between the two nations reached $877 billion, making Canada the single largest export customer for the United States. During an address at the Economic Club of New York on May 28, it was explicitly stated that Canada purchases more American goods than China, Japan, and Germany combined, with 34 American states listing Canada as their primary foreign market. Presenting these figures to institutional investors demonstrates that Canada is positioning itself not as a petitioner seeking concessions, but as an indispensable economic partner. What that positioning does structurally is build an internal constituency of American corporate leaders who will actively lobby Washington to protect their own supply chains. The core of this economic offensive is a government-backed blueprint designed to absorb $1 trillion in new investment over the next 5 years. To unlock this target, Ottawa is committing $280 billion in public capital investments, using state funds to leverage private and institutional financing at a structured scale. The program specifically prioritizes energy, transportation, data systems, and defense manufacturing, the exact sectors where large financial institutions are currently seeking long-term asset allocation. By packaging these industrial projects into a clear, decade-long pipeline, the strategy appeals directly to pension funds and sovereign wealth funds that manage massive pools of patient capital. This approach alters the traditional bilateral dynamic by shifting the conversation from political concessions to commercial viability. The long-term implication is that capital markets, rather than political appointees, will begin to dictate the baseline terms of continental economic integration. Energy infrastructure serves as the primary anchor for this investment pitch, resting on a deep structural dependency that has accelerated over the past decade. Canada now supplies 64% of all United States crude oil imports, a significant increase from 41% in 2015, while also providing the foundational natural gas and electricity that power millions of American homes daily. Beyond fossil fuels, the investment blueprint emphasizes Canada's vast, unmined deposits of critical minerals, including lithium, cobalt, and nickel, which are essential for advanced technology and defense manufacturing. Wall Street asset managers thoroughly understand these supply chain vulnerabilities, making the offer of stable, proximate natural resources highly compelling to boardrooms focused on geopolitical risk. What this energy data reveals is that the United States cannot easily decouple from its northern neighbor without causing immediate, severe disruption to its own domestic manufacturing base. Consequently, this resource dominance will continue to serve as Canada's primary defense against unilateral trade restrictions. This commercial leverage is further reinforced by a stark divergence in corporate tax policy and fiscal metrics between the two nations. Canada's effective tax treatment on new business investment currently sits at 13%, whereas the equivalent rate in the United States is 19.7%. a difference of nearly 7 percentage points that heavily influences long-term corporate modeling. Furthermore, Canada entered these New York meetings carrying a AAA credit rating, the lowest net debt to GDP ratio in the G7, and a banking system ranked number 1 for stability within the group. Presenting these specific metrics to chief financial officers isolates the economic discussion from the unpredictable nature of Washington politics. By contrasting its internal stability with global volatility, Canada is actively marketing itself as a premium, low-risk destination for international capital. This tax and fiscal strategy will inevitably force American states to compete directly on regulatory terms to prevent capital flight northward. The strategic execution of this trip relied heavily on the personal credibility of the individuals leading the meetings. The presence of former central banker Mark Carney, who served as governor of the Bank of Canada from 2008 to 2013, and governor of the Bank of England from 2013 to 2020, transformed the diplomatic mission into a peer-to-peer financial dialogue. Having guided 2 separate G7 economies through major financial crises and systemic market shocks, his presence in corporate boardrooms commanded immediate institutional respect. This professional history allowed the Canadian delegation to communicate in the precise quantitative language required by chief executive officers, bypassing the standard rhetorical patterns of traditional diplomacy. What that institutional credibility achieves is a rapid acceleration of agreements, as Wall Street view the presentation as a stable financial prospectus rather than a volatile political campaign. This reliance on technocratic authority effectively insulates corporate commitments from shifts in public sentiment or changes in government personnel. The immediate reaction from American officials indicates that this targeted message successfully bypassed the standard political resistance in Washington. Following the Economic Club address, United States Ambassador to Canada Pete Hoekstra publicly amplified the presentation, describing it as a constructive framework that a large segment of the American public can support. Simultaneously, United States Trade Representative James B. Greer acknowledged the shared economic interests between the two nations, specifically naming energy, critical minerals, and fertilizers as sectors of mutual benefit. This alignment of public statements reveals a deliberate choice by trade officials not to close the door on comprehensive negotiations ahead of the July QS-May deadline. The strategic sequencing of this entire offensive, engaging Wall Street heavyweights first to secure corporate alignment before scheduling formal talks with United States trade representatives, has effectively altered the power dynamic. But the more consequential question, the one that Continental manufacturers and global asset managers are watching with intense strategic scrutiny, is whether this private sector leverage can actually force a policy pivot in a highly protectionist Washington. This structural positioning effectively shifts the tension from a standard bilateral dispute into a broader domestic challenge for the White House. While Part 1 established that Canada possesses immense economic leverage through energy dominance and specific fiscal metrics, the immediate policy dilemma is how Washington will react to an ally that has systematically bypassed traditional government channels. By anchoring its approach in New York's financial sector rather than the administrative capital, Canada has forced United States trade officials to evaluate the commercial cost of sustained protectionism. That sequence is not coincidental. It is a direct policy statement designed to let the material realities of integrated supply chains influence political decision-making. The true intent behind this banking-first maneuver became clear through the precise language utilized during the Natan meetings. Addressing the audience at the Economic Club of New York, it was stated that Canada is focusing on what it can control by consolidating its forces at home and actively diversifying its partnerships abroad. That specific phrasing reveals a deliberate choice to signal that Ottawa no longer views the United States as its exclusive economic anchor. For an administration accustomed to exercising unilateral trade leverage, the public declaration of Canadian autonomy introduces a new variable to continental diplomacy. What that strategic shift indicates is that Canada is preparing long-term contingency frameworks to protect its internal market from external American policy shocks. www.emgc.ca. This focus on national autonomy is backed by concrete domestic policy changes aimed directly at competing with American industrial incentives. To secure the baseline of its $1 trillion capital blueprint, the Canadian government has established a fixed 13% effective tax rate on new business investment, explicitly undercutting the United States equivalent rate of 19.7%. That 7-point deficit creates an immediate, mathematically verifiable disadvantage for American states trying to retain manufacturing facilities within their own borders. For corporate chief financial officers managing long-term capital allocation models, such a wide tax spread frequently outweighs the political risk of cross-border relocation. This tax framework structurally positions Canada to siphon away institutional capital that would otherwise fund domestic American infrastructure expansion. The timing of these fiscal maneuvers corresponds precisely with a sharp escalation in cross-border trade friction that occurred throughout the previous year. In 2025, the implementation of sweeping American tariffs on Canadian steel, aluminum, and automotive components disrupted long-standing manufacturing networks and triggered immediate, proportional retaliatory duties from Ottawa. That cyclical trade war directly penalized regional economies on both sides of the border, demonstrating the severe vulnerability of single-dependency supply chains. By utilizing identical tariff mechanisms, Canada proved that it possesses the regulatory capacity to inflict parallel economic costs on American export states. The long-term implication of that 2025 friction is that corporate boardrooms now view diversification as a necessary risk mitigation strategy rather than an optional corporate policy. Washington's initial public response to this counter-offensive reveals that the pressure from financial markets is already registering within the administration. Speaking at a trade forum just one day prior to the New York address, United States Trade Representative Jameson Greer stated that the United States plans to maintain tariffs as long as a giant trade deficit exists, while explicitly noting that only Canada and China have actively retaliated against those measures. What that acknowledgement reveals is a deliberate choice to frame Canada not merely as a passive neighboring market, but as a formidable trade actor capable of sustained economic resistance. By grouping Ottawa's regulatory response with that of major global powers, the administration inadvertently confirmed the efficacy of Canada's retaliatory framework. This rhetorical stance ensures that any future CUSMA negotiations will be treated by Washington as a high-stakes conflict rather than a routine bureaucratic renewal. Investing.com. To manage this adversarial dynamic, Canada's Trade Ministry has initiated a multi-layered diplomatic strategy that separates public political messaging from private commercial negotiations. Following the New York meetings, Trade Minister Dominic LeBlanc confirmed that while formal government-to-government discussions remain functional, the administration's primary focus is reinforcing the private sector consensus that stable cross-border trade is in the American economic interest. That distinction highlights a sophisticated understanding of how policy is shaped within the United States system, where corporate lobbying frequently dictates legislative outcomes. By securing the vocal support of asset managers and industrial executives, the Canadian government creates an internal buffer against protectionist White House policies. The future success of this strategy depends entirely on whether these corporate actors can successfully shift Washington's focus from nationalist rhetoric to balance sheet realities. This calculation is further complicated by severe internal domestic pressures developing within Canada itself, which threaten to undermine the narrative of absolute economic stability presented on Wall Street. Even as federal officials marketed Canada as a unified, low-risk destination for global capital, intensive regional debates regarding resource sovereignty and fiscal autonomy began to re-emerge in Western provinces like Alberta. That internal political friction introduces a layer of domestic volatility that international investors traditionally avoid. If provincial governments continue to challenge federal oversight on energy exports and environmental regulations, the long-term predictability of Canada's resource pipeline could be compromised. This domestic tension means that the primary threat to Canada's economic offensive may not be American protectionism, but rather its own internal political cohesion. Policy Magazine, the structural stability of the entire North American continent, now hinges on a single, unresolved institutional milestone. The mandatory review trigger for the CUSMES trade agreement in July 2026 represents the ultimate destination toward which all of these economic and diplomatic maneuvers are converging. Synthesizing these multi-layered diplomatic maneuvers and sharp fiscal contrasts reveals a sophisticated regional strategy disguised as a standard trade mission. The core friction identified throughout this analysis is not merely a dispute over tariff percentages, but a structural clash between two entirely different economic philosophies. While United States trade officials are aggressively enforcing a highly protectionist, state-centered industrial model, Canada has responded by integrating its sovereign credit advantages directly with the profit motives of private international capital. By shifting the venue of continental diplomacy from the committee rooms of Washington to the financial boardrooms of Manhattan, the Canadian administration has effectively altered the operational rules of North American trade management. CTV News for Canada, this strategic pivot marks the definitive end of an economic model purely reliant on unexamined political goodwill from the White House. The decision to market a $1 trillion project pipeline to institutional investors demonstrates that Ottawa is systematically converting its raw materials, tax differentials, and infrastructure stability into tangible commercial leverage. By cultivating a powerful internal constituency among American chief executive officers who view Canadian integration as a baseline requirement for corporate profitability, the administration has successfully injected a domestic lobbying force into the heart of the American political system. This proactive alignment ensures that any future attempt by Washington to enforce punitive trade barriers will be met with immediate, organized resistance from the very financial institutions that underwrite the United States economy. Prime Minister of Canada, Premier Minister du Canada for the United States, this maneuver exposes the clear structural limits of a trade policy governed entirely by unilateral economic coercion. The administration's aggressive tariff enforcement and its decision to prioritize bilateral talks with Mexico City were intended to isolate Ottawa and force significant regulatory concessions ahead of the July QSMA review deadline. Instead, that protectionist stance accelerated Canada's sovereign diversification efforts, compelling an essential trading partner to weaponize its 7-point corporate tax advantage to attract global capital. When major American asset managers publicly validate a neighboring market as the world's most attractive infrastructure destination, Washington's capacity to dictate terms through political pressure is substantially diminished. The White House now faces a delicate balancing act where continued economic hostility risks siphoning critical manufacturing investment away from domestic industrial centers. Prime Minister of Canada, Premier Minister du Canada, the geopolitical consequences of this economic recalibration extend far beyond the immediate perimeter of North America, directly reshaping alliances with major global actors like Europe and India. As Canada actively pursues independent trade frameworks to reduce its single market vulnerability, European capitals and advanced Indo-Pacific economies gain a highly stable, resource-rich partner uniquely positioned to bypass American supply chain disruptions. By presenting itself as an autonomous, low-risk alternative in an increasingly volatile global order, Ottawa is structurally positioning its economy to absorb premium international capital seeking safe harbor from escalating trade wars. This global diversification does not signal a hostile break from traditional partnerships, but rather the creation of a sophisticated multi-market web that effectively dilutes Washington's unilateral leverage. The immediate next moves will occur along a tightly synchronized timeline, as both administrations prepare for the formal integration of these competing strategies. Trade Minister Dominic LeBlanc's impending Washington visit will represent the first major test of Canada's newly reinforced negotiating position, testing whether private sector support can be successfully converted into formal diplomatic breakthroughs. Concurrently, United States Trade Representative Jameson Greer will face sustained pressure from corporate lobbying groups demanding clear regulatory exemptions for vital cross-border supply chains, particularly in energy and critical minerals. As these separate factions converge on the July review deadline, the focus of continental diplomacy will inevitably shift from rhetorical posturing to concrete legislative compromises designed to preserve market stability. The single most important takeaway from this entire economic counter-offensive is that in a global order defined by geopolitical volatility, institutional predictability itself becomes a sovereign weapon. Canada did not attempt to counter political nationalism with parallel political rhetoric. Instead, the administration utilized the precise, quantitative mechanics of central banking to alter the financial gravity of the continent. By demonstrating that capital moves faster than legislation, the deployment of a structured investment blueprint successfully transformed an asymmetric trade dispute into a balanced commercial negotiation. Ultimately, this strategic shift proves that an integrated trading partner cannot be effectively coerced when it possesses the structural capacity to appeal directly to the financial stakeholders who fund the state itself. The ultimate metric of success will not be found in the public statements of diplomats, but on the corporate balance sheets that dictate where global wealth actually resides.